I'm Charlotte McLeod with investingnews.com, and here today with me is Edward Sterck, Director of Research at the World Platinum Investment Council. Thank you so much for being here. Great to have you.
Well, thank you, Charlotte. It's always a pleasure.
Really good to be catching up with you. And of course, as always, we are going over the World Platinum Investment Council's latest quarterly report. So this latest report confirms a third consecutive annual deficit for the market, and I believe supply coming in at the lowest level in 5 years. So I thought we could start on the supply side for a change. I was wondering, we have the price higher. We've seen a breakout since we've last spoken, really. Is that something, we've talked about issues that the miners are having. Is the higher price something that could help to bring supply back online?
To be honest with you, not really. I mean, I think if you look at it from a cost curve perspective, and bear in mind that we're not just looking at the platinum price when it comes to the economics of the PGM producers, but we've also got to consider palladium, rhodium, nickel, copper, the minor PGMs, gold, and all of these, because these are polymetallic mines, the economics depend upon the aggregated price of all of these different metals. The price has improved. Platinum's gone up. You've also seen quite a good bump in terms of rhodium prices and actually ruthenium prices as well. But fundamentally, all it's really done is moved, in rough numbers, the market from being, say, 40% of the cost curve in cash flow negative territory to maybe 10%. And that's in commodity markets, sort of 101 economics, is about where you'd normally expect the sort of pricing to be set at, is that 90% intersection between the cost curve and the price of any single commodity, in this case, the basket price. So I don't think we're going to see any meaningful mine supply response at these levels. And it's also worth bearing in mind that these are, for the most part, deep level underground mines. So even if we had, let's say, another 50% increase in the basket price, you're still not going to see a supply response over the near to medium term, because the development timeframes for developing the ore body and then increasing output they're multi-year. They're not. You can't make these changes in short sort of half-year or monthly kind of timeframes.
That's really good context on the mine supply side. I think that helps to understand what's going on in the market. What about in terms of recycling? Is that something where you're seeing an uptick with the price increase?
Yeah, so recycling is definitely much more price elastic than mine supply is, certainly over the near to medium term. At the same time, it is a bit limited in terms of how much that can increase. At the end of the day, people tend to scrap their old vehicles at a fairly consistent rate, and spent catalytic converters from old scrap vehicles is the main component of recycling supply. So there's just a natural limitation on the pace at which that can occur. If you look back at the period 2019 through 2021, we did see quite a big increase in recycling supply, which was led by the fact that you had a substantial increase in palladium and rhodium prices. And effectively, that kind of brought forward quite a lot of recycling. So the car would go to the scrapyard. The first thing they'd do is just cut that catalytic converter off and get that through the recycling system. And then the rest of the car, they'd kind of get around to processing later on. I think the key point there is that was due to palladium and rhodium prices. So realistically, from a platinum perspective, yes, we've seen quite a big increase in the platinum price year to date, but it's not the main driver of the economics for those scrap aggregators and recyclers. It's really more of a palladium story, even more so than rhodium. And so you need a sustained increase in palladium prices to drive a meaningful change there. That said, we have factored in an increase into our forecast for this year, so recycling is expected to step up a bit. But I think it's important to emphasise that it's not possible really for recycling to fill that gap, fundamental gap between supply and demand, which is expected for this year to sit at about 850,000 ounces. Given the total market is 7.9 million ounces, that's quite a substantial deficit to fill, and recycling, as I said, can't bridge that gap.
Yeah, it is quite substantial, as you're saying. And talking a little bit more about the price. So I mentioned at the beginning of the conversation, it's been on the move since we last spoke back in May. I believe reading the report, it said it was actually the best performing commodity for the first 6 months of 2025, which is quite impressive. Maybe that's changed a little bit now with gold and silver on the move once again. But I remember when we were talking at that time, you're feeling cautiously optimistic about what was going on with the price. How are you feeling about it at this point?
So, I'd say, last I checked, I think it is still the best performing commodity. I have to admit, I haven't actually checked today. And as you say, gold and silver are on the move. I think what I would say in terms of where does price sit today and what does that mean and what's the landscape and what is the outlook possibly, is that in a way it was kind of strange that the price hadn't moved earlier. We're in our third year of substantial market deficits. Those are being satisfied by a drawdown effectively from above ground stocks. But from December last year, we saw significant tightness emerge in the market, and that was evidenced by high lease rates. So the cost of borrowing metal went up from pretty close to zero up to somewhere in the mid-teens. We also saw the London OTC market go into strong backwardation. So both lease rates and that backwardation are very much indicators of tight market conditions. And once the price started to move from May onwards, that was probably just really a natural response to the fact that there was obviously a shortage of metal in the prompt market. What's interesting is that we've gone up from roughly at the beginning of this year a starting price of about 950, peaked at about 1450, so quite a substantial move, as you said. And prices sort of settled at around that level, 1350 to 1450 for a while now, so it's kind of consolidated. But we haven't seen lease rates ease. We haven't seen the backwardation ease. If anything, actually, the market conditions have become even tighter. So in a way, it feels a bit like we might even need higher platinum prices in order to attract more metal into the market from above ground stocks in order to try and ease those tight market conditions. I mean, we'll have to wait and see how things play out, but that's just based upon the fundamentals that we can see at the moment.
Yeah, I remember really for months we've had conversations about the price and wondering why it wasn't moving yet. So now that it has, it kind of feels like something we were waiting for. Is there anything more you would say about above ground stocks? Because that seems important to go over as well, and something that people should be aware of in terms of the market dynamics.
Yeah, so I mean, our estimate of above ground stocks is just shy of 3 million ounces. So let's call it 4.5 months, maybe 5 months of annual demand requirements. The sort of rule of thumb in commodity markets is that once you get below about 6 months of demand being available in above ground stocks, that's when you begin to feel a bit nervous about the potential for a supply squeeze. The challenge is that these are only estimates. So there's a lot of opacity. There's probably a reasonable degree of inaccuracy as well, but fundamentally, we know that they're not clear extant. They are tight. You can see it, as I said earlier, in the market conditions. There are other sources of above ground stocks that we don't capture in our estimate. So you've got ETFs, and you've also got things like exchange stocks. So those are the sort of stocks of metal that are lodged in bonded warehouses to collateralize short positions in futures markets. Both ETFs and those exchange stocks can be a source of supply. But the reason that we exclude them from our estimates is that fundamentally unlocking that source of supply requires price. So, ETF holders, they haven't invested in the ETFs for out and out fun. They've invested because they're expecting to see some kind of return on that investment. And that requires a price increase. So for them to crystallize that and liquidate those investments, you need higher prices. For exchange stocks, it's a little bit more nuanced. It's not necessarily about the absolute price level, excuse me, but it's to do with really if there's a speculative opportunity in the market. And most, as I said, those exchange stocks are collateralized against short positions. So really, what you're looking at is some kind of steep contango in the forward curve. As I mentioned, in Europe, we're seeing it in backwardation, but in North America, because of the tariff fears, there is actually a reasonable degree of contango that's built into that forward curve because people think that they might be charged let's say, 15-20% tariff on importing metal in the future. But these are not precise numbers, but maybe the 3-month future is at a 12% premium. So it's better to buy that than to risk the 15-20% tariff in the future, and that creates an arbitrage opportunity. And taking advantage of that from a speculative position requires collateralizing that short position with platinum. So the availability of those exchange stock inventories is entirely contingent upon other factors that mean that they may not be necessarily available freely to the market.
Very, very complex. And that is going in a direction of another topic I wanted to talk about, which is tariffs. I think that whole situation was pretty in flux the last time we were talking, and arguably still pretty in flux right now. But looking over at platinum demand, I believe in the second quarter, it was down 22%. And this was largely due to dynamics playing out around tariffs. So I was hoping you could go into what the platinum tariff background is right now, how that's looking to you.
So, I think the short answer is, using a word that you touched on there, complex. We don't really know exactly. I'm not sure that anyone even in the White House possibly knows what's going to happen with tariffs. But as things stand at the moment, we've seen this kind of ebb and flow of tariff fears where, when after President Trump was elected, but before his inauguration, he started talking about tariffs. It became increasingly clear that they were going to be an important part of this presidency in terms of policy setting and their view of economics. And so that kind of emerged from December last year. And that's really when we began to see those lease rates kick up. And with the onset of those tariff concerns, you saw quite significant efforts to onshore metal into the US. Now, post, in inverted commas, Liberation Day, when it was initially announced that platinum and other critical minerals weren't going to be tariffed, we saw those fears ease. So the kind of onshoring process reversed to a degree. We saw metal flow out of exchange stocks, possibly flow out of the US back to a combination of Europe and China. And then suddenly we had these kind of copper tariffs that were announced. And I think the economic rationale behind those copper tariffs are quite hard to unpick from a rational perspective. And so that then kind of reignited concerns that other metals, including platinum, might be subject to tariffs. And so we saw the whole process reverse, more onshoring and sort of metal accumulation. And then you add to that, there's this sort of growing ideological disconnect between the Trump administration and the South African government. Again, it's pretty hard to really see what the true motivation behind that is. But given that the current US administration has shown that it is willing to use tariffs as a kind of stick, if you like, for enacting foreign policy, you kind of come back to this sort of whole situation where there's a non-zero chance of platinum being subject to tariffs in the US. And so, again, there's this kind of motivation to onshore metal and so on. So that's broadly where we stand at the moment. How's that going to unfold through the rest of the year? I think it's pretty hard to know. I certainly don't have a strong opinion on that. And like I said, I'm not sure anyone particularly does.
I am also not sure if anybody really can truly say what's going to be coming. So thank you, though, for trying to unpack that. And also on the demand side, I wanted to touch on bar and coin demand. It looks like it was pretty strong coming out of China. So I was hoping you could talk a little bit about drivers there and what's happening.
Yeah, so China's been the big driver of that. I think a lot of it comes back to gold. You've kind of got this de-dollarization sort of action that's going on at the moment. And so that's translating into pretty strong consumer demand for gold as an investment product. And to a degree, platinum is a beneficiary of that. I think the kind of perception in China of price direction risk has been gold's reached a level where they see more downside risk than they see, in contrast, upside potential for platinum. And so it's translating into really robust demand for platinum investment products. And I think one of the interesting things to highlight here is that these are smaller bars and coins primarily. So we're not talking about high net worth individuals or institutional investment. This is true kind of man or woman on the street type retail consumer investment demand for relatively small bars and coins.
Really interesting. And is it a similar situation going on with platinum jewelry in terms of relation to gold, where we've got higher gold price, maybe people are looking over at platinum jewelry? And also curious on the jewelry side, where that demand is coming from.
So I'd say, in contrast to the investment product demand in China, I'd be a little bit cautious in suggesting that we see the kind of momentum that kind of built over the first half of the year being sustained through the second half of the year in terms of platinum jewelry demand. And the reason I say that is that if you look at the second quarter, Chinese demand doubled quarter on quarter. And that, to me, is it's a little bit too big of a step up. And I worry about everyone getting too excited about it and thinking, well, we're off to the races. So a small note of caution. We're definitely going to see a really significant year-on-year increase in jewelry demand in China. It's probably not going to be a doubling, though. It's going to be sort of maybe double digits somewhere, but in terms of percentage increase. But yeah, don't get too excited about it so far. And part of the reason is what's driving that increase has been fabrication funded by wholesalers, and they're promoting platinum because they've seen a huge drop in their gold jewelry sales. So they're trying to find an alternative to recapture that customer buying interest and revenues and so on. We haven't got the data yet. I'm not saying that it isn't translating into true consumer buying. We haven't got the data to prove that's the case. We do with platinum investment products. We don't in jewelry. So, I think there is a strong outlook for jewelry. It's definitely on the up, but I'll be a bit cautious, again, to reiterate about the magnitude of that increase. In the world ex-China, we are just seeing consistent growth. So, it's been, if I've got my numbers correctly, I think about a 3.5% CAGR consistently since 2014. And certainly in markets like Japan, Europe and North America, where you've got a big white gold component to the jewelry market, white gold was produced as a lower cost alternative alloy to platinum. It's only 75% pure. And we're seeing, based upon our own market research, we can see that at the retail level, platinum is now being priced at a discount to white gold, and I think most consumers, given the choice between one or the other in those markets, are going to go for platinum, almost totally pure. And unlike white gold, which is only really white because it's actually got a rhodium coating, which wears away over time, so it does kind of go yellow over a few years of use. Platinum remains white, so it's fundamentally the better choice as a jewelry metal. In that, if you want a white metal appearance.
Anything further you would add on the demand side? I don't think we've covered the auto or industrial segments yet.
In terms of automotive demand, there's not really a huge amount to actually say that's of note, except to comment that actually it's arguably been more robust than we'd have anticipated, given the tariff risks and the negative impact that those tariffs have on the ability to produce vehicles in, let's say, Europe and export them to the US. So automotive demand, pretty steady, and that's probably better than expected for right now. I think going forwards, if you look out beyond this year, higher for longer automotive demand has been our kind of perspective for a while, and that's on a slower kind of electrification of the drivetrain, which has just been an ongoing trend. And I think that's something that's likely to persist. In terms of industrial demand, this year we've seen some glass production facilities close, one particularly big one in Japan. That is a net negative on demand because the metal that's in that facility has been liquidated and sold into the market. I mean, interestingly, the timing of that would have pretty much coincided with the increase in the platinum price in the second quarter. So clearly it wasn't enough to really offset that demand picture overall. But apart from that, the rest of the industrial space is just growing low single digits fairly consistently.
All right. Well, thank you for going into those areas as well. And I'll let you go unless you had any final thoughts that you would leave investors with right now, maybe points that you're watching closely as we head into the final quarter of the year.
Yeah, I think there's probably a couple of things to impart. So firstly, if we think about the supply picture, it probably is going to ease a little bit towards the year end. So we see mine supply, which is seasonally biased towards the end of the year anyway. This year, that was particularly accentuated by flooding in South Africa during the first quarter of the year. So we do expect a bit of an increase in mine supply towards the end of this year. But at the same time, if we think about, we have seen some profit taken from ETFs, we have seen some exchange stock outflows. Just to reiterate, the price has gone up by 50% or so. And yet we still haven't seen any easing of those lease rates or the strong backwardation in the forward market. So fundamentally at the moment, it just appears that the platinum price at current levels isn't sufficient to attract enough metal into the market to really ease those market conditions.
Okay, well, it's definitely an interesting set of circumstances. It'll be exciting to see what comes in the last period of the year. Thank you so much for coming on to talk. I think this was very educational as always.
Super. Thanks again for having me on.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Edward Sterck with the World Platinum Investment Council.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.